Hello, Professor. Hello, class. Our group was assigned the CMBS. We received pre-sale information as well as rating actions from Kroll, Fitch, and Moody's. And to quickly go over the pictures, in the top left, you have the largest loan in the CMBS at $110 million, and that's the Augusta Mall. It's located in Georgia. Below that, you'll see one of the offices within the Molina office portfolio that's located in California, and that's the second largest loan. And in the upper right, you'll see the Meritage and Resort Spa located in Napa, California, and that's the third largest loan in the CMBS. So let's begin. So this CMBS conduit transaction has a starting balance of $1.1 billion. It is collateralized by 83 commercial mortgage loans, which are secured by 136 properties. The weighted average remaining loan term is 9.8 years, and the weighted average life is 9.1 years. And the average loan coupon for this CMBS is 4.53%. A majority of the CMBS is concentrated in retail, hospitality, and office, respectively being 37.6%, 18%, and 15.7% of the entire pool. In terms of location, the collateral securing these loans are located in 26 states, with 64.2% of the entire starting pool balance distributed among the top 5 states, being California, New York, North Carolina, Georgia, and Washington. So this slide is a breakdown of the major property types and their sub-property types. So for example, under retail, you have regional mall, anchored, single tenant, unanchored, shadow anchored. And then hospitality, you have full service or limited service. And so it really just breaks down the major property types as well as the sub-major property types. And this slide shows us the top 15 tenants and this CMBS's tenant exposure. And the top 5 tenants are Macy's, Home Depot, Sears, JCPenney, and Molina Healthcare. And the top 5 tenants represent 27.7% of the total collateral square footage of the CMBS. So this slide is the loan balance distribution. So loan balances range from $1 million to $110 million, with the average loan balance size being $12.8 million. And you see that of the 83 loans within the CMBS, 59 of them are within the 0 to $10 million range at 26.8% of the total pool. And for the last slide in description of collaterals, I thought it was really important to show the top 10 loans as they make up more than half of the CMBS at 56.2%. And it's really symbolic of the entire CMBS because you can see how it's split between the top 5 states as well as the top 3 property types, retail, office, hospitality, and California, New York, North Carolina, Washington, Georgia. And so I thought it was really cool how the top 10 loans are representative of the overall CMBS. And so you really want to look at these top 10 loans and how they perform to gauge the overall performance of the CMBS.
Hello, I will be talking about the strengths and weaknesses of the collateral in our pool. So, roughly 60% is secured by properties considered less volatile, that being retail, multifamily, storage, malls, and those properties, usually tend to have more steady cash flow. They're less affected by volatile markets. And so that is a strength when considering their collateral. And 16 loans of the total are secured by multiple properties, which makes up just under a quarter of the total loan balance. And usually, when loans are secured by multiple properties, there's a bit more safety amongst the loans because the risk is dispersed about over a few properties. And so 15 loans that add up to a little over a quarter of the pool are currently representing acquisition financing. And usually, when you're using acquisition financing, you are getting financing on collateral that you want to be stable, because in order to purchase that next business or that next property, you want to have strong collateral that won't go under, where the financing you receive, against poor collateral, you could lose that financing. Also, there's a strong borrowing quality within this pool, which there's carve-out guarantees to show for no previous fraud or bankruptcies within the borrowers of the past borrowers of these loans. To move on to the final strength, but not limited to this final strength, one of the most important ones is the total trust debt service coverage ratio is 2.36, and that can show for a strong overall trust, meaning that they can pay their debts as well as take more debt if need be. But to have a DSR above 1.5, 2 shows for strong cash flows and being able to cover their debts, and most importantly, being able to cover their debts means that they're not going to run into debt as often. So to move on to the weaknesses, excluding cooperative loans, the trust LTV is 104.7%, and that can cause some issues, and it can pose a major threat to the trust, meaning that if they're over leveraged, you can run into issues with paying off your mortgages, paying off your debt. And to move on, the weighted average grade of the pool is 2.41, and that's kind of high, and which could be a potential indication down the road of weak cash flows of the assets. And with weak cash flows, again, you can run into going negative and potentially some of these loans going underwater. Similarly, some properties within this loan, which makes up a pretty big portion of the pool, 38%, are within smaller markets. And when you have properties within smaller markets, there's more risk, and there's more variability within your cash flows and your cap rates when you have market fluctuations. Because if you're not in a large market where you can come out of it, but if you're in a small market, you're kind of trapped within that small market. Also, within the pool, there are 11 hotel properties and 8 office properties, which make up just about 35% of the pool. And amongst most credit rating agencies, these are considered to be more of the volatile properties. And especially at a time like now, you see so many hotels and hospitality properties that are running into major issues. And if your loan is comprised of, or your pool is comprised of 18% hospitality, at a time like COVID, it could cause serious threats to some of your loans. And of the top 10 loans, 9 of them have borrowers that are recycled special purpose entities, which just means that some of these loans can be exposed to risk associated with borrowers' prior history. And if you have a borrower that has some issues or has fraud or anything like that, it could come back to haunt some of these loans. And it's important because these 9 loans are within the top 10 of the overall trust. Thank you.
Hello, so I'll be talking about the securitization structure of WFRBS 2013-C15 transaction. First off, the master servicer and special servicer are Wells Fargo and CW Capital. and the loan originators and the issuers are the same. The structure of the transaction is a sequential pay waterfall, which means that from the top down, um, each class gets paid at different times, although some of these classes may have the same ratings. Therefore, the only difference among the classes with same ratings is in the maturity of the bonds. Any payments that come in will first go to the top, like the waterfall, to the senior-most bonds. And once all the senior-most bonds are paid off, the next senior-most class will get their principal paid. Payments can include prepayments and even payments that come from recoveries of assets through defaults, should there be any defaults. And opposite to the payments, if there are any losses incurred, that will affect the bottommost, the junior-most bonds first, and not until the entire junior-most class is lost will the next junior-most class get affected. As mentioned earlier in the collateral description, the super senior bonds in class A-1, which holds the amount of $60,151,000 of the pool, that one has a 30% credit enhancement, and the junior most bonds in class F with the amount of $11,070,000 has a 3.5% credit enhancement. Important thing to note is that the junior most bonds rated by Moody's is class C, and that class represents $42,896,000 of the pool, and has a 12.125% credit enhancement. And next, I will pass it on to Zibe to talk about the comparison of the rating agencies. Thank you.
Each company had their own take on the deal, yet we deemed the Moody's to be the most conservative of the three. Two examples of this would be the rating agencies DSCR and LTV. Moody's had a stressed DSCR of 1.41x versus 1.74 from Fitch and 2.42 from Kroll. Moody's had a high LTV of 97.6% versus Fitch's lower 96.9%. The agency examined 90.6% of the collateral, which is way more than both competitors. Also, they alone included a Herfindahl score, which portrayed the concentration of loans. Fitch came in a close second, though, as it also had exhaustive studies. One metric that we appreciated was the cash flow cut that Fitch used. Its cash flow decrease was 9%, which is much greater than Moody's 6.7% cut and Kroll's minuscule 2.4% decrease. Kroll was inarguably the least cautious. There's virtually not one metric that KBRE had that was more conservative than the other two. An example of this would be the rate of collateral that the firm examined, as it only went through 65% of it, and Fitch studied 78% of the collateral, and Moody's studied, as mentioned, over 90%. So this is a considerable difference. KBRE also put its debt yield at 13.5%, which is higher than Moody's 13% and Fitch's 12.5%. Our group would collectively invest in the highest graded super senior bond, but not the junior most tranche. Our logic for this claim goes as follows. The class A1 tranche will definitely not default, let alone take on any losses. However, the junior most tranche seems bound to take significant losses, which would probably outweigh the higher return. We say bound because it's likely that in the 10-year hold period of the deal, there would be a recession that would cause cash flows to decrease and cap rates to increase. Aside from this, we believe that the class of bond doesn't seem worth pursuing for 3 reasons. First, we think that the deal has an overabundance of riskier property types, namely retail and hotel. Secondly, this isn't a first-rate deal, regardless of how one measures it. Thirdly, we are risk-averse when it comes to dealing with a costly investment like CMBS, of course. Our starting issue is then the excessive amount of relatively uncertain property sectors. This deal has more retail and hotel real estate than an average deal of its time. Retail properties make up, as stated, 37.6% of the pool. And while this isn't inherently right or wrong, it's not something that we want. Hotels were the second largest property type at 18% of the pool balance. Fitch Ratings gave all hotels a 4 out of 5 volatility score. Fitch even wrote hotel properties have a much higher likelihood of default. In addition, higher concentrations by property type can lead to increased volatility due to correlations. Now, then, the second issue is that the deal isn't the greatest to begin with. One example of this is that WFRBS 2013 is buttressed by co-op apartments. If these are taken out, then most metrics are visibly worse. While Moody's gives the deal a stressed LTV of 97.6%, with co-ops removed, it would jump up to 104.7%. So in reference to this, the ratings agency wrote, it is among the highest conduit-only leverages measured since 2009. Lastly, we are personally risk-averse when dealing with this securitization. The weighted average coupon is simply subpar. Fitch made a comment on this by writing, the pool's weighted average coupon is 4.53%, well below historical averages. This doesn't seem adequate for the class of bond, especially when it has credit enhancement of only 3.5%. While we didn't buy the junior most bond, we would have purchased the class A1. While WFRBS isn't a fantastic deal, it's still valuable. The securitization is made up of lots of New York City co-ops, which we found reassuring. Thanks to these loans, the Fitch stress DSCR for the multifamily sector is an impressive 4.59x. Another positive for the deal is that it's 24.5% of it is secured by loans that cover multiple properties. And finally, only 12.5% of loans cover single-tenant properties.
Now, it has been 7 years since the issuance of the bonds in 2013. Let's see how these bonds have changed. First, Class A1 and A2 have paid in full earlier, so this slide shows the bonds left. On the recent reports in 2020, among the left bonds, Moody's just downgraded 3 classes, such as Class B, C, and PX, to A2, BA1, and BAA1. Fitch also downgraded 2 classes, Class E and F, to CCC and CC, respectively. Unfortunately, both Moody's and Fitch show their concerns related to negative outlooks, such as an increase in loss expectations and a decrease in collateral occupancy, especially after shares closed. Let's look into surveillance reports. Through Wells Fargo report, which recorded in August, we see how much we earn interest. And both Bloomberg and Kroll show the increased credit enhancement and shortfall from Class G. According to Kroll, this shortfall was due to the liquidation of Holiday Inn Express and Suites in Sydney. Now, I'm going to pass it over to Emily. She's going to talk about the bonds in the secondary market today.
Now, with regards to whether or not to invest in the secondary market, we do not recommend this for the A1 bond given that it's already been fully paid off. And we also do not recommend this for the F bond, just as we didn't at new issue. And the reasons for this are even greater today during COVID in light of the recessionary times that really hit retail and hospitality the hardest. This is expected given that they're the most volatile, but given the fact that COVID is unprecedented and has equally impacted everyone across the world, let alone nationwide, and there's no clear light at the end of the tunnel. The massive losses experienced between the start of COVID and now are likely to continue until there is an end to COVID. And so given the fact that our pool comprises majority of retail and hospitality, whatever losses happen will be eaten first by the F bond because this is junior most. And so it already had very little credit enhancement to begin with at 3.5% at new issue. And it's now been reduced to 2.32% as of the service reports end of August of this year. And Kroll, for instance, has even has already loss adjusted the F bonds credit enhancement down to 0. So really there's no protection should things continue to worsen. And right now that's how things are. The retail and hospitality are still very much suffering. And so while the servicer report states that some of the largest loans are still performing, this may be deceptive because if we dig into the NOI and DSCR metrics, for instance, Augusta Mall, which comprises the largest loan, which comprises 9.9% of the pool, their NOI dropped from 18.79 million from last fiscal year to 9.52 million. As of most recent NOI reporting. And this massive loss in NOI of around 50% or more is all across the pool, from Ohio to Virginia to Washington, what have you. In fact, 15 of the loans reported 0 NOI as of last fiscal year and 0 in their most recent reporting. 2 even had negative NOI as of last fiscal year. Not only that, but 4 loans have already transferred over to special servicing. So this means that things have really gone bad. 1 filed for bankruptcy. There's several in REO. 2 have negative DSCRs even. And 67.1% of the pool comprises expired leases, and those expiring this year, 2020. So really there's no time anymore for the ones with outstanding balances to pay off their debts. So this can be seen in the fact that although the servicer report shows that total interest distribution was paid, if we dig into the advance summary, we see that the servicer advance paid for this. And Kroll also reflects this massive loss in NOI with a negative 13.7 variance to the Kroll net cash flow at last review, using an 11% vacancy factor in light of COVID. Moreover, per the service report, the 23.44% of the pool have a weighted DSCR average of 0.769. So clearly this means there is not enough cash flow, NOI, to cover the debts. So unless things get better for these properties, they will likely go into default, thus extending and even exacerbating the current losses experienced by the pool. Not only that, but 27.4% of the pool have an LTV between 66 and 70. And although this LTV is really quite average and reasonable, only 62.8% of that 27.4% are performing as of end of September of this year. So clearly, from a credit risk perspective, there are certainly issues to be wary of as the junior most F bond investor. And so given the fact that again, there is no light at the end of the tunnel, the fact that the agencies have downgraded the F bonds, so for instance Fitch has done so, and plummets in occupancy in the 10 largest leases have happened. So for instance, JCPenney, Sears, Macy's, Dick's Sporting Goods, Barnes & Noble, H&M, all of which are the top largest leases, they all have occupancy of less than 29.5% and exposures in the millions. So JCPenney has exposure of 22.4 million. And these numbers are really serve as real caveats to the F bond investor. So summarily, with these factors,